Today, folks, we're going to talk about VDY, my monthly paying Canadian dividend ETF until I die, ticker VDY, up almost 25% this year with the dividend. Are you effing kidding me? It has outperformed the S&P 500 over the last 5 years. If I went back 5 years ago and told you that this Canadian dividend ETF would be more stable and have better returns, I would have laughed at myself. I mean, it's even outperforming the broader Canadian ETFs. Like, it is up more than VCE, and VCE is the exact same thing as the S&P 500, but for Canadian companies. Are you effing kidding me? Now, I'm forever grateful and patting myself on the back this year because I missed the AI revolution. Sure, to some extent, yes, but we captured Google, crushed it in this account. I sold a little bit too early, but I'm still thankful my fiance is holding it within her TFSA. But I bought VDY, and I said the only two stocks I want to hold in here is VDY and the S&P 500. Pat myself on the back yet again because these positions have been absolutely crushing it. But I want to break this down a lot more in depthly because it is a very interesting conversation to be had about why I think Canada is going to continue to crush on the back of AI, talk a little bit about Google, and we're going to dive into the major earnings that are upon us when it comes to the holdings of VDY. Like, this is the Super Bowl right now, guys, and you got to be paying attention because if it doesn't work out in the next coming week, this stock will get absolutely crushed, and I recognize it for what it is. So if you're on a path to financial independence, if one day you'd like to retire early, join me in that journey, guys. Hit that subscribe button if you appreciate the transparency of this channel, because right now VDY has some concerns to the dividend investors. I've always told you guys, like, just try and get exposure to the best possible companies. Don't let dividends be the defining factor to your portfolio because it will detriment you over the long term. We've seen that, especially in this current market environment. But look at the dividend today is 3.5%. You go back 5 years ago, you were almost locking in a 4.5-5% yield, and that yield is deteriorating, and that is a problem with a market cap weighted ETF because right now the more recent dividends have not actually been better than they have been in the past. And a lot of investors said, Kyle, should I be worried? Like, this isn't what I bought the ETF for, and I'm sorry if that's the reason you bought it. I bought it to get exposure to a market cap weighted system of the best possible companies in Canada, specifically the banks. Like, we have the most world-renowned banks anywhere ever. Like, I mean, they survived the '08 financial crisis when Greece collapsed. The Canadian banks rode through this without a problem because they're kind of monopolies and they're highly regulated in our economy. And for every $100 you put in this ETF, guys, over 30% of it is just going to 3 companies, with $15 of every $100 you put in here just going to Royal Bank, and then TD at 10%, Enbridge at 7.5%. But then you get the other banks like BMO, Bank of Nova Scotia, et cetera, right? Regardless, the broader financial institutions here in Canada are up 30%. I mean, just the banks and the BMO equal weight bank ETF before the dividend is up 30%, guys. And I'll remind you, when you're buying this ETF, you're basically making a big bet on the Canadian financial institution because as a sector, it makes up 57% of this ETF. Energy is 25%, utilities 5.9%, basic materials 3.8%, and then telecommunication 3.6%. Regardless, you got to be understanding of what you're buying, because market cap weighted ETFs, guys, it doesn't care about your feelings, doesn't care if you think something's overvalued or undervalued. It's just going to weight them off their performance. So if a lower dividend paying stock starts to outperform, it'll naturally weight its way up into this ETF, which is what I love, right? But the problem is if you purely focused on dividends and you're like, I'm just going to buy telecom giants, they're stable, they're great, they have massively underperformed, and because they pay such large yields but are underperforming, they're de-weighting their way out of this ETF. So that is what you have to be aware of, and likely why the dividends have been going down over time. Regardless, as we head into this kind of Super Bowl of earnings for these Canadian banks, guys, I mean, they're trading at the highest valuations they've ever traded at virtually in their entire history of publicly traded companies. This is a really peculiar time. I mean, Royal Bank's trading at a 16 PE. It's a $200 billion company, the largest company in Canada, and the yield sucks right now. It's also one of the lowest yields it's ever paid in its entire history. And analysts are still giving this a relative buy rating with a high price target of $238. And if you take a look, the reason it's able to trade at this valuation is because it is growing unlike any time in its history. It had a 21% net income growth just in the last quarter, guys. And might I remind you that net income growth is being driven by the lowering of provisions for credit losses. So the revenue growth, first and foremost, has been insane. From $14.6 billion to $16.9, almost $17 billion year over year. Are you effing kidding me? Like, that's nuts. But the problem is they couldn't actualize the revenue and the net income because the economy was supposed to collapse. You remember everyone was screaming that all these mortgages are coming up for renewal. They're coming up at higher interest rates. And, unfortunately, the Canadian government, well, not unfortunately, to protect the economy, they tell the banks, hey, because you're monopolies and because we don't want this entire economy to collapse, if those loans get a bit rocky, and what I mean by that is basically if you were sitting on a 1% loan and now you're coming into renewal at a 3 or 4% interest rate on that loan, the bank just says, hey, look, like how much cash flow are you producing to cover that loan? And if that cash flow margin starts to get smaller, the bank gets a little skittish and the government says, look, there's a higher chance of you defaulting. Maybe you're not going to default. I doubt you will. I mean, you're going to fight to keep your mortgage. Some of you are going to default for sure, but the government says we need to take some of that revenue and net income and put it aside to protect the bank. We can't actualize it as net income because it's there to protect us in case all these loans default. So that's what they were doing. 1.4 billion last quarter, but now in the lower interest rate environment, now that mortgages aren't collapsing like crazy, they're putting less loan losses aside, which means us as investors get to actualize more net income. I hope that made sense, you frigging nerds watching this video still. Appreciate you. Hit that like button, folks, because that's what's happening, right? We're getting net income growth unlike any time in history. So if they're going to grow like tech stocks, they can deserve a higher multiple. And to be fair, at a 20% net income growth, a 16 PE is not that bad. And for those uninitiated, the price to earnings multiple is just, hey, if the company doesn't grow net income and it doesn't shrink in net income, it'll take you 16 years to get a full rate of return. But luckily, we're growing much faster than that. So it's actually probably favorably valued in this market environment. And I'm not complaining at all. What about TD? TD has been the best dip buy opportunity out there next to Google, in my opinion, for the Canadian side of the border. And a lot of people were able to actualize on this and they bought the dips, and I congratulate you. And to be fair, they're not even that expensive right now, considering they're coming out of that massive fraud or the money laundering fraud that was going on that drove the stock into oblivion, even though the company wasn't really going into oblivion. We have analyst price targets at 130 with roughly a buy rating, kind of a hold buy rating right now. They're not as bullish, but they should be. Because look at this, 15.3 billion almost in revenue versus 14.1 this time last year. Last year, they had a net loss for the quarter of 181 million. Now they're posting 3.3 billion. Like, come on, guys. They've dealt with the balance sheet and the assets. They've cleaned a lot of it up. They paid the fines. And here we are now in this new growth trajectory that is very similar to that of Royal Banks, right? Like, it's absolutely incredible. BMO is now the third largest bank next to Bank of Nova Scotia here. And if you take a look at this one, everyone's a little more skittish on this company because their loans have been getting a little bit more shaky. Their loan losses actually increased last quarter to 756 million from 644 million and 582 million just a year prior. So there's a lot more concerns around this company, and even with the loan losses increasing on the last quarter, they were able to net 2.3 billion versus 1.8 billion this time last year, and their revenue is still growing incredibly from 5.5 billion almost from 4.8. Like, what is going on here, guys? Like, how are these banks growing like this? There's never been a time in history like this. There just hasn't been. That's why you need to pay attention, especially next week, because next week, over 3 days, the 2nd, the 3rd, and the 4th, we're getting all of these earnings, and they will be literally, everyone's going to be focused on it, and it will define what happens to VDY. Like, we are all hinged on this, but I'm very bullish, guys, or at least I'm hopeful, because I'm a concentrated investor. I'm a lot younger than most people that are investing, and I recognize that I have a longer runway ahead of me to take on a bit more concentrated risk. That's why I focus on ETFs that give me concentrated exposure to technology and the Canadian banks, which have been the best performing, stocks basically in the Canadian economy. But I think the Canadian economy is going to crush beyond expectations because of AI. AI has kind of entangled the US and Canada and basically the global markets in a way that people just don't appreciate. And I'll give you an example here, and we're going to start with something a little bit indifferent, because right now Micron Technologies just recently has exploded coming through the fall into the winter, and no one's really talking about these chip stocks specifically, like Sky Hynix. This is an Asian company here from South Korea, and it just recently exploded through the fall. I mean, year to date now it's up 203%, and it was kind of delayed. Like, these stocks weren't rallying nearly as excessively. Even Samsung wasn't rallying nearly as excessively as some of the other chip companies out there, right? And you might be asking, well, what do these have to do with chips? They specifically make DDR RAM, basically the memory in your computer. They're not like the graphics card or the GPUs, they're just the memory, right? And what's been going on that's just super perplexing is data centers, these big companies that are trying to build the AI revolution out, NVIDIA cannot meet capacity. So these companies are finding workarounds and are realizing that DDR RAM can basically help push some of this AI compute and store it without having to fully like rely on GPUs or lesser powered GPUs. It's kind of a convoluted workaround to some extent, but yeah, look at the growth here. Only as of recently have these prices absolutely exploded, guys, like literally since the fall. And you know, Nvidia's not producing DDR RAM. These other companies are. Now, I don't have the cojones to buy into these, and why am I even talking about them? Like, it's because these companies, they can't supply, they can't get enough components, they can't get enough raw materials, guys. That's the reality. Like, NVIDIA's primary problem, their constraint is their supply chain, right? And we're starting to see Google, and the reason Google's pumping and Nvidia starting to drop is, I told you, the big concern is these other mega tech companies not going to let Pablo Escobar over there, you know who you are, Jensen, you know, playing like you're selling drugs at Nvidia, like they're selling drugs at margins at 80%. It's disgusting. And it only takes a matter of time before another mega tech company says, I don't want to do that. I can go buy, I might not be able to produce chips at the level Nvidia is producing them from a power standpoint, but I sure as hell can go out and buy from ASML the machines that make the chips, and we can produce maybe less powerful chips. But hey, if it's 50% less powerful, we can just double or triple them up at a quarter of the cost. When you're charging 80% margins, I mean, yeah, if it can even produce them at a tenth of the cost, I don't care that they're half as powerful, Mr. Jensen Hong. Like, come on, guys. Like, come on. I mean, we knew this was coming. I've called this time and time again, guys, because Google's in talks to offer its AI chips to Meta, and Nvidia and AMD are falling. And then obviously, you know, Nvidia says the GPUs are generations ahead of Google AI, but it doesn't matter when you're Pablo Escobar and you're selling it for too expensive. Like, we're going to cut that shit, right? Like, we're obviously going to cut it and get it out there because you just can't meet the demand. So what's going on in Canada specifically is we have a few components that really matter to the supply chain of AI, because obviously all attention right now is on commodities, whether you're talking about copper for the electrified future. I mean, EVs are using like 4 times the amount of copper than a traditional ICE vehicle, uranium powering these data centers, you know, gold, precious metals right now absolutely exploding. And the best performing sector of the market has been the non-energy minerals. And these all have impacts across the board, even with the major banks here in Canada, because who do you think is financing a lot of the growth and the mine expansions and, you know, what's going on with the potential of these metals? Because we have the Athabascan Basin, right, which is one of the largest mineral deposits of uranium in the world. We have some of the largest gold deposits. I mean, the U.S. has to rely on us no matter how they feel about it, how much they want to annex Canada. I don't know. I don't want to get into the geopolitical aspect of it, but guys, like I said, you could see some industries like real estate struggle in Canada, but you're going to see that get made up by, you know, commodities and minerals. And the financial institutions are holding on so damn strong right now that I don't see how you could be bearish on the economy for as long as this AI revolution lasts. Now, is it a bubble? Is it going to last forever? No. Eventually, we're going to reach parity. Eventually, things will level off. Eventually, the margins at 80% are going to deteriorate as competition comes into play with NVIDIA. These are realities people just don't want to discuss, but it is coming inevitably. But it could be 1 year, 3 year, 5 years. I don't really know. But I'm going to place my bets where I think my best outcomes are going to be and diversified, so I'm not just completely concentrated in chips and tech. And I think there's no better place right now than VDY, man. What an incredible ETF. What an incredible thing to pair with the S&P 500. Removes volatility, increases some yield, so I have some dividends to invest if we do go into a down period. But again, super awesome, super grateful. What a year, guys. And I'll pass the question off to you. I'd love to know what you think about all of this in that comment section below.